There are several investment options open to a young investor. For instance, saving in a bank account, buying common stock, real estate, stock mutual funds, and short-term certificate of deposits. Each kind of option will have its own benefits and demerits. It depends on the investor's purpose. For example, if you are saving for your retirement and your age is 25 and you start with a $300 regular monthly deposit, earning 9% annual rate for the next 40 years till your retirement age of 65, you will accumulate approximately $1,420,000. Therefore, there are several key steps to be taken into account when investing. Here are 7 tips for young investors saving for the future. Be sure to subscribe to my channel and also click bell notifications so you can join the notification squad. You are always being told to invest your money even when the stock market is volatile. Some even say now is the best time to invest because of low prices. But exactly what should you invest in as a young investor? Welcome Money Finders. This channel is for personal finance and entrepreneurs who want to have financial freedom. In today's video, we'll be talking about top 10 investing tips for young investors. Number 1. Don't let emotions drive your strategy. Don't let market volatility, which is normal and cyclical, deter you from investing in the market. As a new investor, your investment strategy and plan should be designed to help you reach your long-term goals. Having a plan that accounts for these future goals, coupled with a well-diversified portfolio, can help mitigate some of the anxiety that can come along with market swings. Number 2. Begin your investing activities as early as possible. The earlier you start investing in your life, the less financial burdens you'll have in the future. For example, spouse and kids expenses, mortgages, etc. will come at a later point in your life in your late 20s or 30s. Hence, you can easily make a regular substantial monthly payment in the initial years of your youth. Investing early will also have more interest compounding, meaning you can invest in high-risk, high-return stocks. Number 3. Don't put all your eggs in one basket. Think Tesla will dominate the electric car space forever? Well, even if you do, don't invest every penny of your money in Elon Musk's company. Why? If you're wrong and Tesla's stock tanks, you won't have anything else in your portfolio to cushion the financial fall. The concept of owning a wide variety of investments is known as diversification. You are much better off investing in funds that own many stocks in different businesses or a variety of interest, paying bonds to spread your risk around. Number 4. Learn and educate yourself with the entire process. It's essential to be familiar with the market and understand the business you are investing in. The example given in the beginning, $1.42 million, may look a huge sum, but its future value may be equivalent to that of $40,000 of today. Therefore, for a couple that wants to use that money after their retirement for another 20 years or so will not benefit much. Therefore, it is essential that you know the process, the cost involved in the stocks and equity options. Number 5. Improve your skills. Most people don't think of improving their skills as an investment, but as a young investor, that can actually be one of the very best investments you can make. After all, the income you earn over your lifetime will be your single greatest asset. The more you can increase it, the more valuable it will be. Plan to invest at least a small amount of money and time in acquiring any skills you need in your career. You may also think about skills you want to add to prepare you for either a higher paying job or even for changing careers later on. You can take additional college courses, order online courses, or enroll in various programs that will add to your skill set. Sure, it will cost you money in the short run, but if it will increase your income substantially in the future, it will be some of the best money you ever spent, and that's an investment in the truest sense. Number 6. Don't listen to pundits. Turn off the financial news. Bears warning of a market meltdown might spook you out of the market at the wrong time, and bulls predicting that the market will double might make you overly optimistic and vulnerable to a big sell-off if you go all in. A big mistake beginner investors make is taking what's said by others as gospel. Number 7. Learn how to make sound decisions. Many view the stock market as a roller coaster, but they ride it the wrong way. Instead of a quick ride full of highs and lows, start the ride early, travel through the small bumps, and know it will go back up in the decades between today and retirement. Remember though, the key to financial success doesn't depend on the market's performance, but on the sound financial decisions you make each day. Number 8. Diversify your portfolio. Diversifying your portfolio means you must at all times maintain a portfolio that is composed of all kinds of assets, from high risk to medium risk to low risk. The medium and low risk asset compensates the high risk one, and the aggregate returns are generally higher than a single asset portfolio. The wise decision to make is to reinvest your returns to earn greater returns rather than spend those returns. For an investor, this is the best way to prevent a massive setback. Numerous studies have determined that asset allocation is the most important aspect affecting performance and volatility of your investment. In fact, 91% of the portfolio return is based on asset allocation, just 2% on market timing, 5% on stock selection, and 2% on other factors. Number 9. Take advantage of a longer runway. One of the primary advantages individuals gain by investing at an early age is a longer runway. This may sound counterintuitive, but a healthy appetite for risk can be rewarding for young investors. You and the market both have a longer time to recover from any setbacks. Consider investing in a highly rated aggressive growth fund. You can always calibrate your exposure to risk as you age. Number 10. Invest only in what you understand. Be wary of investments that appear to be overly complex or seem too good to be true, or to invest in a business that you don't understand. If you are unfamiliar with forecasting success in a field you don't know, e.g. developments in pharmaceutical drugs, information technology innovations, etc., it is safe advice to pass on it. There are so many other ideas out there that you will understand that is not worth wasting too much time on trying to understand a sector you don't know by heart. Stay within your competences and have the discipline to research and only buy investment products that you will fully understand. As Peter Lynch once said, never invest in an idea you can't illustrate with a crayon. So money finders, what can you add to our list of top 10 investing tips for young investors? We love hearing your comments and feedback. Now you always watch our video till the end. Here is your bonus. Always remember the 5 golden rules of investing. 1. The greater return you want, the more risk you'll usually have to accept. 2. Don't put all your eggs in one basket. Try to diversify as much as you can to lower your risk exposure. That is, invest in different companies, industries, and regions. 3. If you are saving over the short term, it's wise not to take too much of a risk. It's recommended you invest for at least 5 years. If you can't, it's often best to steer clear of investing and leave your money in a savings account. 4. Review your portfolio. A share might be a dud, or you might not be willing to take many risks as you did before. If you don't review your portfolio regularly, you could end up with a share account which loses money. 5. Don't panic. Investments can go down as well as up. Don't be tempted to sell or buy shares just because everyone else is. To learn more about top 10 ways to start investing, the Rookie's Guide for Investing, click into this video right here. And if you haven't yet, make sure you subscribe. Thank you so much for watching. I will see you next time.